Can you switch this fan? The fan band karo.
Voice is not clear.
Okay.
It's okay, but it is somewhat some breaking is there.
Okay. Is it clear now?
Now it's okay.
Okay. So thank you for joining for this webinar, and once again welcome each one of you for today's webinar on governance for strengthening the microfinance institutions. Special thanks and welcome to Sri Dharmendra Bagade, the DGM from Reserve Bank of India, who will be delivering a keynote address for this webinar. We also have speakers from PwC, Mr. Pankaj Purohit and Koshi Thomas, and also Mr. Priyesh Rupalia from CARE. So my special welcome to all three of them. I'm sure today's discussions will be quite useful to everyone, and we will be benefited out of this webinar. As we know that governance is an important thing for any institution, not only for a microfinance institution, any institution, whether it is a government institution, non-government institution, corporate institution, any institution for that matter, governance is an important thing. This is all the more important when you talk about microfinance institution, because in microfinance institution, it has to play a dual role. One is that to ensure that the social outreach is the social purpose for which microfinance institutions are formed, that is kept. Second is that it also needs to ensure that financial self-sufficiency and financial proper management has to be there. So board has an important role, a dual role. So that is very important as far as the MFI governance is concerned, or the board is concerned. When you talk about the governance, naturally the board is the one which we talk about. But even the senior management for that matter is also part of the governance only. But then board, the promoter, the board, those things becomes very important, especially the constitution of the board, the persons present on the board. They are all very important. When a lender sees an organization, especially for financing and all, the first thing they see is that who is the promoter, who are the board members, what is their background. So that makes it very, very important. As I said, it has a dual role of ensuring social outreach as well as financial self-sufficiency. It also very important when you talk about the risk management and the fraud management, those kind of things, because we deal with so many people, so many borrowers, so many staff members. So keeping a proper tab on each one of them and ensuring that things are not going wrong. Especially we know that the segment which we cater is a very, very sensitive segment. Anything going wrong can become a news. So one has to be very careful. So the administration, the governance has to be properly keeping a control on that. Investor confidence or public trust is also an important thing as far as any institution is concerned, especially microfinance institution is concerned. So laying down the policies and abiding by that is also an important thing. And above all, the regulatory adherence, because most of the institutions of microfinance institutions are governed by under the regulatory control of Reserve Bank of India. And also it has got other regulatory requirements also. So ensuring that the regulatory adherence to all these things are very important for the institution to serve. So on the whole, if I say, it's a very, very important aspect as far as the institution is concerned. So we need to really really take care of a good governance to ensure that a sustainable growth and equitable growth happens. So in that connection, this webinar is going to be very, very important, and we'll be getting much more insights from our speakers. So with this, I stop here and once again welcome each one of you for this webinar and thanking each one of you for sparing your time for this webinar. And hand over to Sri. Thank you.
Thank you, sir. Now I am requesting Sri Dharmendra Ramajibhai Bagada, Deputy General Manager, Department of Supervision of Reserve Bank of India, to deliver the keynote address. Sir, the session is handing over to you.
Thank you very much, madam. And thank you, Gigi sir. to Gigi sir, before I start my formal introduction and welcome address, I just want to share a few things about Gigi sir. This is my fourth or fifth seminar with him. Every time I meet him and see in him the equal and rather higher than energy of my age person. He is an university in microfinance in himself. So this is for you,
Thank
Gigi
you.
sir. After every 3 months gap, I am watching him and always with the same energy. So keep doing the good work, sir. It's for you.
Thank you.
So good afternoon, distinguished
Yes,
members
sir.
of the board, respected lenders of the microfinance industry, and the representative of Sa-Dhan, ladies and gentlemen. It is really indeed a privilege to be here today, and I sincerely thank Sa-Dhan, Sa-Dhan and the organization, Sa-Dhan and the organization to providing this opportunity to address such a distinguished gathering. On paper, microfinance may appear to deal with small value transaction, but the true impact of this sector cannot be measured by size of individual loans. Uh, its impact is reflected in the confidence it builds, the livelihood it creates, and economic participation it enables. In our collective journey towards comprehensive financial inclusion, it is evident in remarkable rise of India's financial inclusion index that RBI publishes. It was 43.4% in March 2027, and it has rise to 70% in March 2026. This progress belongs to all stakeholders represented here today. I must say that microfinance is not just a mechanism for extending small credit. It is rather a process of converting borrower into entrepreneurs. An informal activity into productive participation in the formal economy. Over the past decade, the sector has undergone tremendous evolution. We have progressed from traditional GLG model to sophisticated digital underwriting, diversified products, and seamless digital disbursement systems. However, this rapid growth also demands greater responsibility. We have seen in the past repeatedly that there were unchecked expansion of aggressive underwriting and excessive growth target that led to over indebtedness in the household and repayment distress was also seen. The strength of any institution, much like the strength of any building, is much like strength of any building, and it ultimately rests on its foundation. That is why the strengthening of governance, discouraging aggressive lending practices, and embediment of customer-centric ethics into the DNA of every microfinance institution is not only the regulatory expectation, but it is very essential for long-term credibility and sustainability of this sector. And allow me therefore to briefly share Reserve Bank's supervisory expectation and governance standards on this sector. I believe there are 5 elements that should remain non-negotiable if the microfinance sector is to continue thriving as trusted partner in the inclusive growth. The first is an independent board. It should comprise the individual with the expert in the finance, risk, technology, law, the individuals who truly understands the decision that they approve and who satisfy fit and proper criteria, not merely in form but in substance also. Second, the committees, be it audit committee or risk committee, that establish and enforce, exposure limits, limits across geographies, products and ticket size, all this concentration risks, and it should ensure that all these items which I just narrated do not become the fault lines in the industry. Third, a genuine and well-defined risk appetite. The institutions must establish a clear threshold for geographic concentration, multiple lending exposure, and NPA trends. Geographic or segmental concentration can quickly convert local disruption into institution-wide challenges. And we have seen this also in past in Karnataka and some other places. This is equally important that the board must ensure that early warning systems identify stresses before it becomes delinquency. Fourth, the meaningful disclosures. Board must receive dashboards that reflect reality, not sanitize quarterly summaries. They should monitor movements in PAR, SMA trends, complaint volume, pricing outliers, and collection practices. More importantly, this dashboard should present not only financial metrics but also the human realities behind these numbers. Fifth, and the final is succession planning and organizational culture. The leadership at the board level transition must be planned deliberately. Even more importantly, boards must set the ethical tone from the top, because the conduct observed in the field invariably reflects the value demonstrated in the board. The Reserve Bank has consistently maintained that financial institutions should never prioritize short-term balance sheet expansion over long-term and customer protection. Let me therefore turn to what responsible lending truly means in practice. First is household level assessment remain fundamental. The existing regulatory ceiling that household monthly repayment obligation should not exceed 50% of the household income is meaningful only when the underlying income assessment is honest and comprehensive. Equally important is timely and accurate bureau reporting. That is not happening. I mean, we have seen it because both this comprises responsible lending and responsible borrowing depend upon the reliable information. Then only a reliable decision can be made. Pricing should reflect cost and risk, not opportunity. Then collection deserves equal attention. Many institutions increasingly rely on business correspondence and recovery agents, but outsourcing collection does not outsource the accountability. Responsibility of customer treatment always remains with the lending institution. That we all should not forget. Similarly, grievance redressal mechanism must be genuinely accessible. Board should evaluate not only how quickly the complaints are closed, but how effectively they are resolved. Technology has undoubtedly transformed this sector. Many of you are investing significantly in digital underwriting, AI-driven credit assessment, and advanced analytics. I welcome these developments. However, technology should strengthen judgment and not replace it. The model should remain explainable. Exception should receive human scrutiny. Algorithm must be continuously monitored. And with this, the models must be validated. It should be back-tested, and it should eliminate any inaccuracy and unintended biases. So with this, I wish to conclude my opening remark here, but we all should not forget one more thing, which is the recent disruptions that we are noticing in recent years. That is erratic rainfall, floods, heat waves. These are not isolated events any longer, but these are increasingly becoming the credit variables. Okay, so the institution must demonstrate some flexibility during this genuine natural disaster time, and they should support the borrower at that time. That is an appeal from our side. With this, let me conclude, and over to you, the team Sa-Dhan. Thank you very much for giving me this opportunity. And the Reserve Bank provides the industry with a greater flexibility since 2022, because we believe that the sector was ready to shoulder the higher responsibility, and we keep on helping the sector create opportunity for yourself with responsible lending and responsible and accountable board and governance. Thank you very much. Thank you very much to all.
Thank you, Dharmendra ji, for your wonderful insights from RBI. And let me tell you that and appreciate RBI's confidence in microfinance sector, because we all know that in 2022, when the new regulatory framework was brought out, a lot of freedom was given to the institutions. I mean, most of the policies has to be decided at the board level rather than prescribing from the RBI. So that shows the kind of confidence RBI has on these institutions. So it is our responsibility to see that this confidence is fully kept and it is adhered to. So and especially with regards to the responsible lending, I fully accept and appreciate the points which Dharmendra ji has said. We have a responsibility to ensure that the lending becomes more responsible and does not cause any kind of a harm to the borrower. So thank you once again to you, Dharmendra ji. I hand over to Sri.
Thank you.
Thank you, sir. Thank you for your insights, and it will help us to work on responsible lending in a more better manner, I would say. Now, before going to the next session, I would request everyone, every participant to put your name and designation and the organization name on the chat box. It will help us to share the PPTs and other pointers with you. And also will request everyone who is not speaking to keep yourself on mute. Now I will request Mr. Chandan Thakur, Deputy Director of Sa-Dhan, to share a brief presentation on advancing governance and responsible lending oversights in micro-lending institutions. Chandan, the session is over to you.
Yeah. Good afternoon, and thank you so much, Sri. And it's really good to to get the background from Gigi sir and Dharmendra ji points, particularly on the 5 non-negotiable element. That's already covered points we would like to touch upon during our presentation. I hope I am audible.
Yes. Please go ahead.
Yes.
So I will take a brief time to just make a small presentation. We have already some experts from PwC and KRH Group. So we will just touch upon the importance of governance in responsible lending and particularly in the overall architecture of microfinance lending institutions. We all know the importance of governance and already highlighted by Dharmendra ji, like how it matters, particularly on the 5 elements, which is quite non-negotiable, and that really helps. If you go on the next slide, please, Sri, why governance matter? We know that's changing microfinance landscape over a period of years. That's growth in portfolio, rising ticket sizes, and gaps in at times in due diligence that have widened the gap between origination and oversight. That is really important. If you see, we have witnessed in various states, the country is so diverse. The changes in the asset quality, indebtedness, client protection, regulatory expectation, that is equally important. We know RBI scale-based regulation places higher accountability on board, particularly on the risk and compliance issues and culture. So these things really matter for a good governance. Next slide, please. The 3 lines of control and digital oversight, business and operation, risk and compliance, internal audit. There are a lot of things which we can do on the digital oversight, that is real-time portfolio monitoring, credit bureau integration, AI-assisted early warning alert. As we know, the microfinance sector, many MLIs are adopting AI in various ways. Then moving next, we have fraud detection, plant compliance tracking, compliance monitoring, and these things that could be done from digital oversight. There are broadly we can segregate the governance among 4 pillars. That is board oversight, independent directors, well already highlighted by Dharmendra ji, risk and audit committees, documented escalation framework. That's equally important. How do we escalate the things? Code of conduct. We know in the microfinance sector, there is an industry code of conduct. We expect all the MLIs to comply with the industry code of conduct in terms of fair practice lending, transparent practices, ethical collection standards, responsible lending, equally important. There are JLG discipline, robust income assessment. We are adopting the new models in terms of individual lending also. Adherence to the SRO guardrails. We know last 2.5 years we have witnessed some disruptions at the sectoral level. There have been guardrails, and we can witness the improvement at the sectoral level. Client protection, that's equally important. The grievance redressal mechanism, CGRM access, that accessibility, adaptability for the borrowers is very important. Client education, that we keep organizing all the our members and Sa-Dhan at the institution level, lot of financial literacy program to aware our borrowers about their financial right, what the RBI regulation guidelines suggest, the fair practice code, the code of conduct, the transparency part. So we keep aware our borrowers, and that's very, very important. Moving next. The board oversight, there are we have segregated into two, three pillar point, and the board oversight. If you see the independent board representation, as widely recommended, there should be 1/3 independent board members, independent directors in the governing board, with expertise in the domain like microfinance operation and risk management. Dedicated risk and audit committee. There should be dedicated subcommittees that focus on the risk and audit. Documented escalation formats I touched upon earlier as well, like how the internal channels for raising and resolving conflict, conduct, compliance, and credit quality. Fit and proper leadership standards. That's equally important. The screening of key management personnel consistent with RBI scale-based regulation expectation. These things the board must focus while conducting the oversight. Moving next. The code of conduct part, fair practice lending, we touched upon earlier, how we do the underwriting, equal access to the same rate, no prepayment penalties, transparent pricing, full APR, fees, and total cost of credit disclosed. These are the key area, ethical collection conducts, election standards, respectful communication at reasonable hours. Everything we keep communicating, we are well aware. It's important for the governing board to ensure these code of conducts are implemented at the field level. All the staffs of the particular organizations are complying with these things. Moving next, please. Responsible lending, as we have been discussing the microfinance framework, there have been different evolution on this collective collaborative lending models built on mutual support, financial discipline, household income assessment. We all know it's how important. Verified income and obligation checks before sanctioning, aligned to the RBI guidelines and SRO's norms. Indebtedness guardrails, again, there is a cap. We need to ensure that in overall, in a nutshell, the board oversight must be on the responsible lending. That really helps to stick with the guideline and the client protection. This is important. We all know how we can protect our customer, our consumer, client, that accessible entry points, toll-free helpline, member institution, front offices, and SRO. There are various ways, and our borrowers must know what are the various ways that they can, that accessible, that access they must have. Defined resolution timeline. Everything should be based on a proper TAT. That turnaround time is important, and board oversight must focus on those time or those TAT. Escalation to the SRO in case it doesn't get resolved at the institution level. There should be three-tier escalation. First at the institution, then at the SRO, and third, the last should be at the RBI level. Feedback into governance. The governing board, the board oversight must focus on the feedback part also, like how the grievance patterns reported back to the board to inform about the training process and policy changes if required. Moving next, please. Monitoring and early warning indicators. There could be many that sector analytics turn that board can focus on as a early warning indicators. One could be, of course, PAR, portfolio at risk, like what are the trend, what are the emerging asset quality stress by aging buckets, QMR submission. It should be properly analyzed, feeding sector-wide compliance and risk review, growth versus guardrail ratio. These things must be supervised and analyzed. Grievance and recovery conduct trends. Moving next, please. Sa-Dhan's role in sector governance, being a SRO, Sa-Dhan always strive to make a proactive role to support its members to create a conducive environment to make sure that we follow the responsible lending, comply with the guidelines prescribed by the Reserve Bank of India. At the sectoral guidance level, we convey industry task force to reinforce guardrails and code of conduct, compliance monitoring, reviewing member adherence to RBI norms and industry code of conduct, grievance escalation, operating an independent CGRM channel for unresolved client complaints. We have a toll-free number in 11 languages. And capacity building, that's an important task that Sa-Dhan does at a regular level, supporting members on governance, risk, and responsible lending practices. Moving next. Recommendation for the road ahead. We know how it is important to strengthen our board and strengthen board level risk committee with dedicated indebtedness and risk oversight, automate credit bureau check at the point of sanction, standardized CGRM turnaround time, reporting uniformly for sector-wide benchmarking, embed PAR and guardrail ratio dashboard, and into monthly board reporting and all. So these are some of the steps that we can take to strengthen our board and board oversight. So I guess next please, Sri. Yeah. So that's how in terms of today's presentation that we have touched upon. So yeah, thank you so much. Thank you, Sri.
Thank you, Chandan. Now we are moving to the next session. Our next session speaker is Mr. Koshi Thomas, Partner PwC, and Mr. Pankaj Purohit, Executive Director of PwC. They will have a brief presentation first on building trust, accountability, and responsible growth in microfinance. Requesting PwC team to take.
Good afternoon, everyone. Am I audible? Just checking. Am I audible?
Yes.
Yeah. So Pankaj Purohit this side. I am executive director in GRC practice within PwC. I primarily focus on the financial services client. I'm also joined by Koshi Thomas, who is a partner in the practice. Maybe Koshi, if you want to quickly introduce yourself, and then we can take it forward from here.
Thanks, Pankaj. Good afternoon, everyone. Very pleased to be here today. Most of the aspects that have been spoken till now will resonate with us as well. The address by Sir from RBI, then later by Chandan. A lot of aspects are broadly getting covered. We'll also try to reinforce or reiterate some of those points in a manner in which we see as we operate with our clientele and in the sector.
Thanks, Koshi. Yes. Maybe we'll start. First of all, thank you for the opportunity where we could take this session on the governance beyond compliance. The theme is building trust, accountability, and the responsible growth in the microfinance industry that we are looking at. Over the years, the microfinance has actually played a very transformative role in expanding the financial institution, empowering women, supporting livelihoods, creating opportunities for the people who didn't had opportunity to have access to the banking world that we're talking about. As the industry grows, the expectation is actually increasing from the regulators, customers, investors, and societies are also evolving. Over the years, if we see, the sector has evolved significantly. The institutions now have a greater scale, wider outreach, access to the technology, and also increasing the flexibility at the same time. At the same time, the regulators, investors, customers are expecting higher standards of accountability, customer protection, and also the transparency in which the financing institutions are actually dealing with the day-to-day conduct with respect to financing the customers, how the internal governance mechanism are actually working, and so on and so forth in that sense. Governance is often viewed in general parlance as policies, committees, the framework, and the compliance requirement. But in reality, the effectiveness of the governance is much broader. It influences how the decisions are made, how the customers are treated, how risks are managed, and how institutions earns trust from the stakeholders that we are talking about in terms of the entire journey from the microfinancing institutions. I would request Neha to maybe go in the next slide. This was a quick context or a background in that sense. So why governance matters more than ever? The first theme that we're talking about is there are three pillars that we're talking about. First is financial inclusion impact. Microfinance institutions are expanding access across formal finance for unserved household and also supporting the entrepreneurship and women empowerment. With this social responsibility comes with an obligation to ensure the fair and responsible lending practices. The lending practices that we are doing is it needs to ensure that we are actually assessing the customer in the right sense. We are not actually over leveraging from a customer standpoint. At the same time, giving the fair, I would say, in terms of the pricing, the way customers are being dealt with, not only at the time of onboarding, but across the journey that we are talking about. The second very important aspect is financial inclusion impact. So microfinance institutions are actually expanding access to formal finance for unserved household and also supporting the entrepreneurship. With this, social responsibility comes with an obligation for a fair and the responsible practices. The third part is the competitive advantage. So trust is no longer a soft concept that we're talking about. Organizations that build customer trust typically experience a stronger portfolio quality, greater resilience during the stress period that you're looking at, and also enhanced reputation across the marketplace that you're talking about. And hence, in terms of the three pillars, financial inclusion, rising expectation, and trust as a competitive advantage, overall plays a very important role in the entire life cycle of the journey from a customer standpoint, not only at the time of origination, but also from a loan management, even at the loan closure as well. So in a nutshell, governance is no longer about satisfying the regulatory expectation. It's about creating the trust from a customer standpoint that we're looking at. Yes, we can move to the next slide on this. Yeah. So traditionally, the governance discussion was focused more on the structures, be it board, committees, policies and procedures, and also the controls. Today, the focus has actually shifted from structures to outcomes. So outcomes would mean that the board, the senior management, not only have to look at from a governance standpoint, they have to actually own the outcomes, not only from a financial results standpoint, be it your profitability, how the loans under management, which is asset under management, are growing. It's more to do with what are the customer outcomes, what are the risk culture that you're looking at, and what are the responsible business practices that the company is going through. Governance effectiveness should be measured by the outcomes that is delivered, not just by the documented policies and procedures that we're looking at. The second very important element from a governance standpoint is the independence of the control function that you're looking at. Be it risk, compliance, and internal audit must sufficiently have a sufficient authority, resources, direct access to the leadership. Often, we have seen that where the control function is not adequately staffed in terms of their experience, skill sets, and all that, the typical watchdog, which the role that is being played by the control function, be it risk, audit, or compliance, is technically diluted. The role of the control function is not simply to identify issues and highlight to the management, even the board. Their role is beyond that. They are actually entrusted with the responsibility to do a constructive challenge and also provide an independent assurance to the board and even the stakeholders at large. So strong independent function actually helps to build the trust more from a stakeholder standpoint. The third pillar that we're looking at is on the customer centricity. Every decision that the company is taking has to be evaluated more from a customer impact standpoint. This not only means treating the customer fairly, also monitoring the complaint trend, ensuring that the intended customer's outcome are actually achieved in that sense. And in a lot of cases, we have also seen that while the loans or the facilities are actually being extended to the customer, the grievance redressal mechanism actually takes a backseat, because there's always a catch-24 situation where you are trying to grow the organization, build profitability, build a better balance sheet size. But at the same time, how you treat customers, how you ensure that the customers are being treated in a right manner, I think that plays a very important role, not only at the customer level, or also at a board level as well, where they actually demonstrate the importance of the treating customer fairly. And last very important element is on the responsible growth. The growth is actually meaningful only when it is sustainable. So, and this actually has a very strong relationship with how my underwriting practices are being evolving. I should not have a practice where I'm actually getting over leveraged from a customer. Today, it can be a better where you are actually able to sustain, you're able to show a strong balance sheet growth, asset under management, and so on and so forth. But in the longer run, I think that will not give you strong results. And hence, strong underwriting practices has to be a fundamental principle that you're looking at. How my incentive models are actually aligned, how long-term portfolio quality is prioritized over a short-term expansion is that we are looking at. And also, as highlighted in the presentation, the measure of the governance is not existence of the policy, but the quality of the outcomes that we have actually delivered in that sense. I think we can move to the next one. Yes. So, what governance or what good governance actually looks like in practice? So there are total 4 pillars, and it has again been spoken in the previous sessions as well. The first is fair lending. The governance actually starts at the lending stage. The institutions must ensure that the appropriate underwriting practices, assessing borrowers' affordability, the preventing over indebtedness, or also responsible lending protects both customers as well as the institutions. If you're over leveraging from a customer standpoint, the default is inevitable. Very important. And the second part is the collections part. In numerous guidelines issued by the Reserve Bank of India, and even the customer complaints that we're looking at an industry wide, there are a lot of practices which are coming out from a collection standpoint where the customers are not being treated properly. So the collection practice actually should be respectful, ethical, and consistent with the customer's dignity. Oversight of a third-party collection agency is very important, because technically speaking, the collection agency, although it can be outsourced, but they are actually representing the organization that they are actually associated with. And it actually depicts the image of the company as well. So that's where fair collection is a very important element that we're talking about. Fair resolution, again, it's on the customer relationship management. A strong grievance redressal mechanism is a hallmark of a good governance, where there's a proper oversight by the senior management, even the board as well. The objective is not only to close the complaints, but resolving the root cause and also improving the customer experience in that sense. Looking at the root cause actually helps to ensure that these kind of complaints actually doesn't recur again, and also improving the customer experience. Last is on sustaining the relationship. When the customer is actually treated fairly throughout the journey, the organization actually benefit through a stronger trust, better portfolio quality, and the long-term business that we are looking at. So in nutshell, things that needs to be monitored is complaint trends, repeated borrower strength indicators, portfolio quality, collections, audit and compliance finding, maybe to summarize that. Moving to the next slide, Neha. Yeah, I would request if Koshi can come in and share his experience also on this.
We are short in time as well. I'll take a minute to summarize what we have in hand. So the question is not about just whether governance is necessary. It's more about how do you act on it? What do we prioritize is going to be the key question that we need to look at, and also how it can help support growth, sustainable growth. Few pointers we already spoke about. One is certainly on household. Looking at the household, serving the household is going to be more important than just servicing a loan. And that will make sure that the industry is able to grow sustainably. The second important factor is giving more and more importance to control functions. There needs to be a very strong mechanism of check and challenge. As Pankaj was mentioning earlier, that's something we see deficient in many organizations. Important to bring that. And when we say if that function doesn't work properly, times governance layers won't effectively work. AI as a part of delivery and AI doesn't result in bias, going to be quite crucial as we move forward. Early warning signals is something that should not be just used by management and ops team. There's something that needs to get fed to the management, senior management, as well as the board, so that necessary action could be taken. The last 2 points are related to conduct and culture. The way an organization run would largely be based on the way incentive structures are laid down or how an exception is handled. So it is very important that right set of mechanisms are set up so that the right behaviors are shown in front of the client. And with that, let me go to the last slide, summarizing it further. Governance is what is going to create trust. Trust is what is going to create inclusion. And inclusion is what is going to help you with sustainable growth. With that message, we'll conclude our conversation. We'll be happy to share any more insights that we can as we move forward as well. Thank you. Thank you so much.
Thank you, sir. Thank you so much. We'll have a Q&A session later with everyone once we have all the presentation. If anyone have any question, please put it in the chat box so that we can take it up later. Now I will request Mr. Priyesh Ruparilia, Director and Rating Head of BFSI Care Age Group, to give us, share his insights, and he will also have a brief presentation on key rating considerations in assessing governance in MLIs. So,
yeah, thank you, ma'am. Good afternoon, everyone. Am I audible?
yes,
Yeah.
sir, you're audible.
So, good afternoon, everyone, and thanks to Sa-Dhan team for having me here. Today, I'll talk about assessment of governance in MFIs from CARE's perspective. Being the latest speaker, I think I'm running the risk of being repetitive with respect to some of the governance aspects. So please pardon me for that. In this session, I will share how CARE ratings evaluates governance, what distinguishes stronger institutions, and key areas that one should focus on to enhance organizations' long-term sustainability. Governance is one of the most important qualitative factors in any rating assessment. Strong governance enhances institutional resilience and builds confidence among lenders, investors, regulators, as well as customers. It has been observed that governance weaknesses often emerge well before the financial stress actually becomes visible in terms of numbers. Poor decision making, weak controls, or inadequate oversight can gradually undermine the strength of an institution. Thirdly, governance directly influences access to funding, borrowing costs, and overall value of the franchise. And finally, scrutiny from regulators, investors, and lenders continues to increase, making governance a strategic necessity rather than a compliance obligation. From CARE's perspective, governance quality is often the factor that differentiates two institutions with otherwise similar financial profiles. When assessing management and promoters, we focus not only on experience, but also on the quality and sustainability of leadership. Starting with the corporate group structure, we check whether the same is simple or complex, and also dig deep into entities' related party transactions and whether there are instances of supporting group entities at the expense of other debt holders. We also evaluate promoters' track record, reputation, and ability to build a credible institution. In cases where shareholding is granular or there are multiple promoters, the timeliness and effectiveness of decision making in critical situations could get affected. Senior management experience and stability are critical, particularly in microfinance sector that demands strong on-ground execution capabilities. We also assess the strength of the second line of leadership because resilient organizations cannot depend excessively on few individuals. Key person dependency is also one of the major governance risks that boards should continuously monitor. Another important consideration is how management has handled difficult periods in the past. Performance during stress often reveals the true quality of leadership in our view. Ultimately, two questions guide our assessment. Is the institution promoter driven or institution driven? And is there a well-established succession plan for future leadership business continuity? The board of any company serves as the cornerstone of effective governance. Strong board provides strategic direction, challenges management constructively, ensures accountability, and oversees risk management. It also plays a crucial role in safeguarding the interest of all stakeholders. So while evaluating governance, CARE ratings takes into consideration board's composition and its independence. Diversity of expertise is particularly important in the areas such as finance, risk management, microfinance operations, etc. We also assess whether the committees are functioning effectively and whether the board is actively involved in key strategic decisions. CARE rating also interacts with the audit committee of rated companies, which helps it to assess the independence and involvement of audit committee in organizations' overall decision making. An important indicator of governance quality is the extent to which ownership and management responsibilities are appropriately separated. Boards that ask difficult questions early often prevent larger problems later. In microfinance sector, risk management is inseparable from overall governance quality. We evaluate how management identifies, measures, monitors, and mitigates the risks. This includes credit risk framework, underwriting standards, collection controls, and portfolio monitoring systems. Liquidity management and asset liability oversight are equally important, particularly during the periods of funding stress. Institutions should also monitor interest rate risks as well as geographic and borrower concentration risks. So in our view, strong institutions should have a conservative and clearly defined risk appetite, robust early warning systems, and an independent risk management function capable of providing objective oversight. Compliance is often the reflection of overall governance environment within an organization. We at CARE Ratings carefully review inspection findings from the Reserve Bank of India and also examine how institutions respond to supervisory observations. We assess whether the concerns identified by regulators are addressed promptly and effectively. Any history of penalties, warnings, or recurring compliance issues warrants close attention. In essence, compliance should not be seen as a box-ticking exercise. It is an evidence of management discipline, organization culture, and governance maturity. There is a famous quote actually which says, integrity is doing the right thing even when no one is watching. Reliable financial reporting is a fundamental to stakeholder trust. So in our assessment, we focus on the timeliness of audits and quality of financial disclosures. Auditor qualifications, observations, and any significant concerns raised during audits are important inputs for us. We also review changes in accounting policies and evaluate whether provisioning and income recognition practices are prudent and conservative. For example, some MFIs make higher provision cover in the form of management overlay for future uncertainties, which is a good accounting practice in our view. Care ratings analyzes financial and non-financial parameters of an entity, whereby a detailed inter-firm analysis is done to assess the company's relative strengths and weaknesses in its present operating environment and its prospects. We also monitor equity valuations, bond yields, and credit spreads of listed NBFCs relative to peers to assess market perception of their value, risk, and ability to raise funds competitively. Governance assessments extend beyond management discussions, actually. We at CARE make it a point to seek independent feedback from statutory auditors, lenders, debenture trustees, issuing and paying agents, and investors to understand various aspects, including debt servicing track record, covenant breaches, timeliness of other reportings, etc. We also seek feedback from audit committees on various aspects, including related party transactions, internal financial controls, audit quality, whistleblower complaints, regulatory inspections, quality of data submission by the management, etc., etc. Strong audit committees serve as governance anchors by providing independent oversight and strengthening accountability within the institution. Investor expectations actually are expanding beyond traditional financial metrics to include ESG considerations. From environmental perspective, MFIs may face indirect exposure to their lending portfolios, but particularly where climate events affect borrower livelihoods and repayment capacity. In current situation where we are witnessing multiple weather events such as floods, heat waves, El Nino, etc., exposure of MFI borrowers to such events and impact of the same on their financial position becomes very critical. CARE Ratings estimates that 2/3 of MFI industry borrowers are involved in agricultural and allied activities, and hence the sector may witness some impact of El Nino in the current context as borrowers' income is likely to get impacted. Social factors are especially relevant in the microfinance, whereby responsible lending, customer protection, employee welfare, and effective grievance redressal mechanisms are important indicators of institutional quality. In the recent past, we have seen some state governments coming up with ordinances to restrict unethical collection practices and usurious lending rates. Governance remains the foundation that supports both environmental and social initiatives. Transparency, compliance, board oversight, disclosure quality, and fair treatment of stakeholders are all critical considerations in our view. As investor scrutiny increases, strong ESG practices are likely to become a very important differentiator. To sum up, let me just summarize some of the characteristics that distinguish stronger institutions. These organizations have experienced and credible management teams, independent and effective boards, and a deeply embedded risk culture. They demonstrate transparency in financial reporting and maintain a strong compliance record. They invest in robust internal controls, audit processes, and succession planning. And most importantly, they place customer at the center of the business model and governance approach. On a closing note, I would like to quote Winston Churchill, who had said that the price of greatness is responsibility. So in microfinance sector, governance is the exercise of that responsibility to various customers, to investors, to employees, to regulators, and to the society. Institutions that embrace this responsibility are the ones that are most likely to achieve their sustainable growth and enduring trust. Thank you everyone for your attention, and would be happy to take up questions if there are any.
Thank you, sir. Thank you for your insightful presentation. Now I will request the participants, if you have any query or questions for the speakers, please raise your hand and share that.
How's that?
Requesting Priyesh sir to just close the presentation.
Yeah, I think.
Yeah.
Thank you, sir. So,
Thank you.
is there any questions to any speaker from the participants side?
We didn't see any questions in the chat box also. Of course, we got a suggestion, suggestion from Mr. Raghunathan and Equitas that we will be examining separately. Anyone has any point to raise? Any suggestions?
Sir,
Any
Gigi sir,
point?
myself Sundaraj from Ashirwad.
Yes, sir.
Considering the present cost of inflation and increase in
Yes.
living standards, the minimum subsistence allowance of 10,000, even if it is considered as 50%, is too low. So my suggestion is the earlier limit was fixed at 3 lakhs around more than 4 years back. That can be considered to increase to give a good portfolio. We can also consider at lower level also, we can also consider the little higher side. That recommendation can be made through SRO to RBI to increase the limit. That is one of my suggestions.
Yes, sir. Noted. But then this was already discussed with RBI last. I don't know whether Dharmendra ji is still there on the call in the meeting webinar. We discussed it with DOR RBI. They feel that probably it is little early to take a view on that. But then we will be following up this
Okay,
case.
thanks.
I also feel there is a need for it.
Any other suggestion from anyone else or any?
And one more thing I want to say, sir.
Yeah.
To verify the CAC records, any change in phone number or any such things are finding difficult. So a unique number can be given. That also might have discussed. A unique number can be given to everyone. That will be useful to enquire the CAC data correctly to find out the indebtedness of the borrower.
You mean to say every borrower should have a unique number,
Yes.
whichever be the lender?
Yes, yes. Because somewhere it is voter card is maintained, somewhere it is Aadhaar is maintained. So with the change in phone, telephone number, mobile number, we may not be able to find out their actual indebtedness.
Yeah. No, true. I think this is an issue which we have been facing, and we have been also talking to the RBI on this. The best thing is to make Aadhaar as a common ID for everyone. But then, see, right now also for the identification purpose, you can use Aadhaar, maybe KYC and all you can use. But data storage with credit information companies, they don't allow it. So unless that is done, it will not be of use. So we have been talking to RBI and we will continue to take up this issue.
Thank you, sir.
It's a need. I fully agree with that.
Sir, this is Paramasivam from Equitas SFB.
Yes.
I want to bring one point to your attention, which we have discussed earlier also. When we do the bureau inquiry through Equifax, and later on we have done an exercise with the CRIF. So we found there is a mismatch. If we take the quarterly reports of last quarter, we found there is a mismatch in all the three criteria for lender count or DPD or the customers outstanding indebtedness. So all the three parameters we found mismatch between the both. We have done a sample check between both the thing. Equifax report we cross-checked with the CRIF, and the CRIF data we cross-checked with Equifax. So we want the your attention that which one we need to consider, which company we need to give more weightage, because in CRIF we are also finding the mismatch, and Equifax also we are finding the mismatch. Based on the bureau records only, we are taking the decision and we are dispersing the loans. Post dispersal on the loans, when we receive some quarterly adherence report, we see there is some mismatch in that. So we want Sa-Dhan to give us some guidance on that. but because all the companies are giving their daily update on their live base portfolio performance, then ideally there should not be mismatch between both the reports.
You are perfectly right. In fact, all the four credit bureaus, although Experian is not very active in this field, but other three are definitely active in the microfinance segment. So all the four are supposed to have the same set of data, that is the RBI guidelines. But unfortunately, you are right, and we have been, this was brought to our notice earlier also by some other institutions, that there is a variation between the reports taken from those two different CACs. This could be because the data is not properly uploaded in all the four. Actually, as per the instruction of the RBI, the same data has to go to all the four at a time. But that is not happening in some cases. Some of the institutions upload only to one particular credit bureau with whom they have the transactions and contacts. So others upload to all the four. So that mismatch is happening. So it is basically a problem with the institution which are uploading the data. That's what I understand, because we discussed it with the credit bureau also, and it was raised with the RBI also. And I understand that this could be the reason why there is a variation happening.
So we should, if possible, you please take steps for making one gateway through which all the organizations will push the data, which will go and reach the bureaus, so that the mismatches can be avoided on a later date, sir.
Right. That is something, that's a suggestion for such.
Sir, and second one, there are certain organizations who are not registered entities with SRO, and their bureaus, their companies, customers' bureaus are reflecting, but they are not part of our registered entities, sir. So that also we need to check once.
Yeah, that is also an issue which has been pending for some. In fact, earlier Section 8 companies were allowed to upload the data as well as access the data. Now RBI has totally stopped that. So that itself causes a problem. Then there are other kind of data mismatches, what do you call it, gap is there, like some of the institutions which are not regulated by RBI, they can't upload the data, or the loan given to SHG under the SHG bank linkage program, that doesn't get reported individually. So all these things are there. There are data gaps, no doubt about it. So only way to avoid a kind of a trouble for the lending institution is to have a little more closer assessment of. I mean, when you are assessing the credit eligibility of a household, have a little more closer discussions and try to try to understand from themselves itself or from the neighbors whether there are other loans pending against these persons. Yeah, but this is something which we have been taking up for some time, and that will be there. We'll continue to do that.
Okay. Sir, and last point. Sorry, ma'am. Last point. Sir, while as per the guardrails, wherever the organization has been given a leverage of deciding up to which year's delinquency that we can able to consider for 60 DPD. So few organizations consider pre-COVID also they are considering, and few organizations considering post-COVID. So there is no uniformity in that approach. So if Sa-Dhan can intervene and give us guidance that all the organizations can consider only the post-COVID DPDs, so there will be an uniform approach and it will benefit even customers also, sir. Because many customers are coming who have taken loan pre-COVID, they are in overdue, they are not eligible for the loan. Few organizations are still funding, few organizations are not funding. So that one, if you can bring in one standard rule, it will make everyone, it will be helpful for all of us and also for the customers also.
I agree with you. I take that up.
That's it, sir.
Thank you.
So there is one suggestion kind of question from IDA Financial Services. With multiple digital platforms available, how can lenders practically verify your borrower's total concurrent debt in real time?
Unless it gets reported to a credit bureau, it becomes difficult. That's what I was telling. There are a lot of data gaps as far as the credit bureau is concerned. A lot of data is not getting reported. One such case is this fintech, which is not regulated by the RBI. The data does not come to the credit bureau platform. So there is a gap. Similarly, other institutions are also there which are not regulated by RBI and they can't upload the data or access the data. And as I said, even the bank linkage, SHG bank linkage data, which is a loan given by the banks, but that doesn't get reported individually. Maybe as a group or something like that they report, but not as individual. Although there is a sufficient RBI guidelines regarding this, and they should also be reporting this. So we need to be a little more careful at the time of assessment. That's all I can say. At the individual level and also level, when you do the loan assessment, be a little more careful in understanding what kind of liabilities they carry.
Mr. Mahadev has said that RBI is taking steps to upload data to CIC on weekly basis, may improve. So his point is that RBI has in the latest guidelines direction, they have said to upload the data within a week, so that may improve the real time.
But there are also some of the institutions which are not able to upload the data. You know? For the regulated institutions,
Institution, it may help.
Yeah, so yeah, that period of 2 weeks have been brought down to 1 week now. Yeah, that will definitely make things a little more better, no doubt about it. Because for a microfinance borrower or a microfinance institution, even 1 week is a longer period of time.
1 day is better.
So slowly it should come to 1 day. Yeah, as many of the MFIs are doing practicing. Yeah.
There is some question.
I think it is.
Yeah. I hope there is no other questions. If you have any, you can definitely reach out to Sa-Dhan, to our SRO@Sa-Dhan.mail ID. We'll happy to take your questions and discuss it further. Now I will request Gigi sir for a vote of thanks.
Thank you. In fact, all the two presentations as well as the keynote address of our RBI DGM Dharmendraji has been quite insightful, and including the presentation made by Chandan also. It all focuses on one aspect, that governance is an important thing, and it's an important thing for ensuring responsible lending and also ensuring that the social objectives which the microfinance institution have is fully achieved, and also ensure that there is no kind of any kind of I would say bad practices happening, because the board has to take full control on that, and they need to ensure a proper monitoring of the happenings in the institution. Then only we can expect a responsible lending and a smooth functioning. So I thank all of you for being here for this webinar, and I hope it was useful to everyone. And one thing is very clear from especially the presentation of the CARE, when they rate the institution, governance is an important aspect. And that is what even the lenders also do. Governance is an important aspect. So who are the board? Who are the members of the board? Who is the promoter? Who is the who are the members of the board? How many independent members they have? What type of committees they have? Whether the committees are active or not? Whether they have independence in their functioning. These are all very, very important. I'm sure this will be taken care of, and so that our functioning will also improve. For information, right now, Sa-Dhan, with the support of NABARD, we are doing a microfinance accelerator program in which some of you must be already participating. 21 MFIs have been identified for that purpose, and they are also one of the focus area is governance, how to improve the governance. Of course, along with risk management, fund management and all, but governance is an important aspect which we have given under that program also. So it's a very important thing, and for the growth of the institution, for the sustainable development, it's an important thing. So we need to follow all the principles of good governance. So with this, I stop here and thank each one of you for coming and being part of this, especially our speakers, Mr. Dharmendra from RBA, DGM RBA, Mr. Purohit and Koshi Thomas from PwC, and Priyesh from CARE. Thank you so much for your wonderful and insightful presentations. Thank you so much.
Thank you.
Thank you. Thank you for having me here. Thank you.
Thank you.